let's start into our last panel of today, which is going to be how can education providers play an active role in the implementation of the InvestEU S&E Guarantee and benefit their students. So, in our day-to-day business at the European Investment Fund, we are focused on guaranteeing portfolios of loans which are normally implemented by traditional banks. So we have heard of the Erste Austria, we have heard of Mikrobanka, and several more. Now, in the Skills in Education Guarantee, we however see 19%, so almost 1/5 being implemented with alternative lenders. And in these alternative lenders, 6% are actually education providers themselves. This one is a very interesting one because an education provider, way better than any bank will do, knows their students. They've had them in a selection process, so they know them. And because of that, they are willing to actually take a higher risk when going into the financing for these students. So what are the two types of financing that we encounter with the alternative lenders and with the education providers? The two main instruments that we find are the deferred payment schemes and the income sharing agreements, which both of them allow students and learners to commence their studies now and then repay the disbursed amounts at a later point in time. Talking about the deferred payment schemes, as for example provided by a reskilling education provider like a coding bootcamp, as they are supported by Quotanda, of which we're going to hear more in a minute, will allow a student to not repay their disbursed loan amounts or the deferred loan amounts during the study period as well as the grace period during which they can find employment. And then upon the start of the repayment period, they can start repaying the deferred amounts in normally fixed installments. Yeah? So if we have a higher tuition amount, what we see is that we have an extended period of time over which the students will have to repay, which negatively affects education providers who only start receiving increments of cash flow after an extended period of time. When looking at the students, and I think this connects back to the question that we've just heard, it does not really connect to the academic success or the performance of our student and learner in the job market following their education. And this is where the second type of financing comes in, and that is the income sharing agreement. So, if an income sharing agreement is offered, as for example by the International Business School Constructor University, of whom we're going to hear more in a minute, they would allow a student to enroll and to enter studying, right, enter the study period, and then commence their repayment upon the completion of their program in the repayment period. The interesting part during this is that the student will have to earn above a certain minimum salary, in our language the income contingency level, which I'm going to look back to in a second, and they will pay a preset percentage of their salary for this repayment. Now, if a student would not have found employment, or the employment that he has found will only yield an income below the set minimum, he would not repay, and at the end of the repayment period, the provider of this financing would find themselves at a loss. However, if this student and learner would actually perform normally or even outperform, he would repay up to a preset maximum aggregate amount, whereby he would offset losses occurred by underperforming students seen on a portfolio, and thereby leads to a normalization in the achievement of the lender in terms of his financing targets. Both forms of student financing enable students and learners to up and reskill or to pursue the education they want to pursue, independent of, and we have heard it before today, of their socioeconomic background, of their financial means that they have when they commence their studies. So instead, it is based on their future ability to earn their income. And this is what we strive for with the InvestEU Skills and Education Guarantee. So, democratizing the access to education is something that we at the European Investment Fund share with the loan service provider, Quotanda. Quotanda, founded in 2012, is a pan-European service provider for specialized education financing. They have developed and run their own information systems to support over 70 partners, and we have just heard about this challenge in 8 countries, so in 8 different legal jurisdictions. In student lending programs, both deferred payment schemes and income share agreements. And as a service provider, they will help education providers to implement all of the steps that normally would be in a financial institution. So we're talking about the setting up of the program, the marketing, compliance checks, selection of students, automatic credit decisions, loan disbursements, the administrations of the European Investment Fund Guarantee, as well as collection and default management. So, I would like to welcome the co-founder of Quotanda, Lino, to the stage. Just to stay in the flow, I would also like to introduce Anna Radünzel, Head of Student Financial Services at Constructor University, to the stage. To add a little bit of context for Constructor University, Constructor University, formerly known as Jacobs University, is a privately owned and accredited research university that teaches fully in English while being established in Germany. They have been established in 2001, and they offer a bachelor's program, master, as well as PhD studies in the 3 areas of health, mobility, and diversity. And they have a strong focus on the professional development of their students, which comes with a low acceptance rate, so a focus on excellent students, the highest of standards in terms of research and teaching, and something which is not that common in higher education, which it is focused on intercultural and cross-disciplinary teaching due to their constant studying and living students on the campus with 1,500 students, which come from over 100 nationalities. So, having this diverse of a student body, it leads to challenges when looking at what type of or how student financing can take place and how the repayment of deferred tuitions takes place within the university. This is the challenge of Anna's team on a day-to-day. They offer the students from the financing of the invoicing to the reminders, everything involved with the student financing, and they are supported to do so by Brain Capital, of whom we've heard before with Professor Rudolph. So, opening the panel, I would like to direct my first question to you, Anna. It would be, when did Constructor University start offering student financing? And what have been your lessons learned so far?
Yeah, hello everybody. I'm happy to be here on the panel today. Yeah, we are a university that started off with our first incoming class in 2001, and we've actually offered student financing from the very beginning. So the main goal, as we've heard in the introduction, actually was always that we are very international. So the original name of the university was International University of Bremen. So it was even in the name. So that goal that we have reached, that one goal of having all these different students from all these 100 countries on campus, was always part of what we wanted. So we are, I don't know if that was clear, we are a residential university, so our students live and learn on campus, and that I find makes it also a very unique place here in Europe. I mean, it's a very common setting in the US, for example, but for Europe this is very special, and that is always also what I found also working there as one of the most unique things about that place, because of course it attracts also from the administration, people from all kinds of countries. So we started off with student financing, as I said, from the very beginning, because we wanted to attract these students from all of these countries. So apart from merit-based awards like scholarships, or also need-based awards like discounts, so this is a direct discount then on the tuition fees, we also offered what we call tuition deferrals from the very beginning. At the beginning, it was what you had here as a deferral scheme. So it was a scheme that is kind of loan-based. So we charged an interest, and the students had a very kind of strict repayment time. I mean, it's like a loan, so not very flexible once the students go into maybe further studies. So this has always been a challenge also for our students in repayment. In 2019, when we also partnered with Brain Capital, we started offering income share agreements. And the difference at the time was, in addition, that we started offering it to all admitted students. Before, it was part of our need-based financial aid system. So students had to actually apply and show their financial background, and then we would check the eligibility based on our internal regulations. But in 2019, we started to just offer it to all incoming or all admitted students, obviously with the option to accept or decline it. We have an acceptance rate of our tuition deferrals of about 60%. So that's the students we're currently financing. And then with the guarantee, obviously, it helped us to actually continue this, because as we have heard before, it is a challenge at the beginning and the first few years, because it's such a long duration of these. You offer like a tuition deferral, you offer an income share agreement, but you're actually only getting the returns when the students are working. And obviously the first few years are a challenge for an institution to finance or to make up for that kind of loss in cash or potential cash income from the tuition fees. So we as Constructor University, we have always had financial investors to help us with that, but in general, this is one of the biggest challenges in the starting phase. So maybe I'll leave it to that for right now. Yeah.
Thank you. Maybe Lino, you can also introduce us to what Quotanda has administered in terms of student lending, and like what your journey has been with deferred payment schemes as well as income share agreements.
Great to be here. Thanks for organizing the event. So we started as an alternative lender back in 2013, and one of the problems we had with just being a direct student lender was how do you manage and measure risk, right? Like Microbank was saying before, a lot of the players, well, we don't know. You have to actually wait 6 or 7 years to know, right? And investors sometimes are not very comfortable with that. Of course, with a EIF guarantee that changes, but at that time, coding bootcamps started emerging in Europe, and some of them were like, hey, we have students, I mean, we have partnerships with employers, so we know these students are going to get jobs. But these courses cost 6, 7, 8,000 euros, and people are not, they don't have the money to pay, and no bank is willing to give a loan, at least at that time, right? So why don't we offer them? I mean, we know they're going to get the job, so why don't we as a education provider offer it? I'm like, okay, well, we know how to manage this. will be your infrastructure provider, will do the origination, risk analysis, and servicing. And you as the school will take the risk. So that's what we started doing back then. And it's working very well because the schools, they're building all of these partnerships with employers. They have the data, they do admissions, right? So they're not really actually looking for return on capital. It's different. As a lender, you're looking for return on capital. As a school, you're looking for, I mean, usually your tuition price, it's, let's say 10. Average ticket price is 8. So if you're already lending at 10, you're still making a good margin there. So that's how we started there. We've been always focused on social impact, and we were able to find some foundations, banking foundations, that were interested in actually offering, instead of scholarships, income share agreements, right? So we know if already a deferred tuition program, which fixed payments, you still have the uncertainty of people might pay you or not, and that's how you collect that. With income share agreements, it's, time X, time 10. Like when are they going to pay you, if they're going to pay you, like what are the loopholes, what are the regulatory issues. Germany, I think it's quite interesting that you have a model since '98 pretty much with data, but elsewhere there's no data. So we started actually going to these foundations, and foundations were offering income share agreements, but not with the purpose actually of earning money. It was just with the purpose of actually creating a reimbursable scholarship. So it's a totally different game. You're looking for social impact, and you're looking just to, I mean, if before you were giving $100 or $1,000, now you're looking just to get back some of the money and be able to reinvest. And that's what we've been doing with some banking foundations. And then some schools came to us and said, hey, wouldn't it be so amazing if we would have an evergreen fund financed by alumni and a bit of the scholarship budget, and that's like an evergreen fund, and future generations are going to be financed by current one, and like creating a flywheel effect, right? And that's something that I think in terms of social impact is very powerful. Again, the unit of economics are a bit different, but yeah, that's what we're doing.
Something like a reverse generation contract.
Yeah.
As we had before. Yeah. And in terms of the uptake, like what would you say? Are these two financing instruments known enough with education providers?
So, I mean, I would, at least on our view, if you ask most of the education providers, they would say, hey, I mean, I would love to have an external partner that gives us the money, and that's it, we forget about it, right? So we know cash flow issues. But the reality is that doesn't happen in many cases, right? So they have to come up with these schemes, and usually there are sales and there are admissions department that see the opportunity. But it's not something that common, because at the end of the day, the school's business is not lending. And I think, Anna, you could probably give more information about how hard it is for a university to actually start offering these ISAs and payment plans.
Yeah, and especially in the context of a very international student body. I mean, we've heard before that Europe is losing 1 million work from the workforce every year. So I guess it means we have to bring people from outside of Europe to Europe, which is partly what we're doing as a university setting that is so international. But it poses at the same time these additional layers of challenges, because as we've also heard before from Brain Capital, for example, if we only had German students and we had German students repay us, then it would be very simple and probably very easy to calculate what the returns are. But with our super international student body, it is a lot more difficult, because we don't know where they're going to be, where they're going to work, what is the income level. We get a bit of data. We have also heard about data. We don't really have the data yet because it is still so new. I mean, we've started with the income share agreement only in 2019, so we're a bit ahead. But even that, then you have a 3-year bachelor's program, then they might go on to do a master's. So they're only just about to start making their first payments. So we also don't have actual data. And that is the biggest challenge also when trying to refinance these or trying to get banks to invest. We don't have real data. We can assume. I've heard interesting ideas, maybe we have to network later, about how you can predict data, how can you do that? But that is really the biggest issue right now, that the concept of the income share agreements in general is such a lengthy one. So it's about several years. So we would only know probably in another 5 years or so, how it is working out, or have like a better idea of the trend. And that is really the biggest challenge. So yes, of course, as you said, it would help to have, especially in the first years, you know, additional support, you know, to offset for that cash flow issue here, you know. But yeah, that's the problem. Yeah.
It's actually a curious point. It's would you say that there should be a funded product in order to support education providers in the implementation?
Yeah, I mean, as I said, I mean, that would be the biggest help, especially when you start. I mean, because that is really, I mean, you need an investor. You need, you know, we need to make up for that loss of income. Constructor University has always had an investor, but even that is limited. I mean, in the medium term, not really long term, we have to also be financially fully sustainable in order to survive, you know, even with a guarantee like that. So I could see it is a huge challenge, especially also for new institutions, even newer than we are. And we are still new enough, even though we're 20 years, but for a university, that's not a long time. So yeah.
Would you have an insight for us how Constructor is bridging this gap in terms of financing?
Well, we are, as a university, we have a shareholder system. So we have a shareholder comes in at the very beginning. We had the town of Bremen like invest in this idea. Basically, it was an idea also to kind of bring the world to Bremen, to this nice campus that we have. So you need either from the politics, like from the public side, or you need private investors. So at the moment it's a private investor, yeah.
What is your take on this, Lino?
So what we've seen is that some of the education institutions or universities, if they don't have the support at the end of the day, what they'll do is just put quotas. So let's say, okay, we have a class, each class is 50 students, we can do with this alternative financing 5. So it will become just a niche product. It won't grow if there's no actually financial help, right? So you have, of course, more private that are maybe venture-backed companies, or that have like larger investors that are actually might have the cash to do this, but you still have some of the more traditional universities that actually don't have the cash or don't want to put this at risk.
One of the points that we heard before in terms of also limiting this was regulation. So as a question, if you could get additional support on the European level, what would help you more? Like additional forms of funding, or maybe even regulatory changes, or I would say adjustments in the consumer lending and student financing?
Okay, so I'll jump on this. So at the end of the day, like, this is not the natural business of a school, right? You're starting to operate this. So definitely the financing, it's one of the issues. The other thing, it's regulatory at the end of the day. We've talked about this, it's just totally fragmented across Europe. I mean, you have countries where this is the Wild West, you can do whatever you want. There's countries where you cannot do anything. There's countries where it has to be interest. Like, and at the end of the day, we're not talking, most of these education institutions, they're like, 60, 70 years, they have like a board of directors, they're like good reputation, they need to make sure that that's perfect, right? So I actually think the stamp of EIF is something important. And then now let me, please take this with humor, okay? So educational institutions are very good at marketing, capturing like all of the part with talking with the students, educating the students, updating their curriculums, like it's so much work they do, right? And now we come with this product, which is fantastic, and we say, okay, now you're going to become partial lender because it's going to help you grow, it's going to help you increase social impact, you're going to create this amazing product to help future generations, attract talent. Okay, so, and actually there's EIF, which gives you a cap guarantee. So I get first question, I'll send you the terms. Okay, Lino, what's a cap guarantee? Good, okay. Second, Lino, we're not a financial intermediary, we're actually a school. Is this thought for schools? Well, actually, in the case of this guarantee, yes, you will become a financial intermediary. Okay. What is enhancement access to finance measures? It's like, well, that actually means that, they're giving you this to actually help students. So how are we going to help the students? Okay. So this graph that says 80%, 25%, so how does this work? How do you analyze risk? then you have to explain, well, it's basically, you lend out 1 million and then let's say tickets of 10K each, you get back 8, but maximum, 200. Like these schools are doing amazing work, but this is not their language. This is the banker's language, right? So actually implementing this for them, it's tough. On the operation side, of course, we come in on that side, but also on the language side of the guarantee. If you look at the terms, you would need to basically put ChatGPT and say, okay, just say, what is a final recipient? Oh, that's a student. What's a final recipient transaction? That's a student that you send on an Excel spreadsheet to EIF. And then if it defaults, they just give you the money back 80%. So we will need to create like this kind of language, I think. This, please take it with humor because everything is very well written. But for schools that they have another kind of business, it's actually hard for them to do this. Of course, the front office does an amazing job. They come, they do the presentation, and then almost everything is clear.
Yeah, let me jump on that because that is actually very true. I couldn't have worded it like that, but this is, I come from how I worked at Constructor University before. I come from the student advising side. I was a student advisor. What is the funding? How does it work? And then you become, as you said, a lender. And of course, we have kind of a history of doing this, and it was administered at the beginning at the university. But we've noticed also that this is actually a huge challenge to become kind of like a bank, and then obviously you're not, but it's kind of that kind of skill set. So we were happy at the time that there was a partner like Brain Capital that we could also hand over that to an experienced and well-skilled kind of service provider also in that sense, because we're using Brain Capital also for that, so as a service provider to help us administer this, at the beginning, very daunting exercise here. So, and you want to do it right. And obviously with the guarantee, there's even another layer of doing it right, because, this is all public money and you're reporting and you have all this on top. So it is very helpful to have someone at hand, and maybe, the language to adjust to the intermediary, but I've learned a lot, but so that might help kind of in the first step, maybe also, to have people or institutions kind of not be so afraid, maybe also, of what they're getting into.
Strong feedback, thank you. Yes, we are quite aware, and we are also thankful for the loan services like Quotanda, who effectively help us then in the interaction with the education providers. Yeah, so it is something that we also strive for.
So just adding, I think in terms of like the ISAs and the social impact a bit, just talking a bit more about that. It's like, for the students going to an education institution that is actually aligning interests with them. It's such a powerful tool, right? Before you were in the education space, you were having you were buying degrees and that was it. And there was no actually, there were some national statistics that you would become some mathematician, you would get X% employability rate, better schools, worse schools. But if you look at the schools, the work they're doing actually with their alumni, with their placement services, with everything they're doing and how that fits on the ISA and what confidence actually gives to the students, it's just impressive. And if you talk to the students, for them knowing that repayments will actually benefit future generations, it's a very, very powerful tool.
What would you recommend education providers who want to implement ISAs? Beyond this, what do you see as the benefits of it?
So, definitely you need to have a strategy of why do you want to do this. So it's is it because you want to capture more students? Are you maybe losing 20% of the students that don't have enough funds? Is it a social impact of a marketing play? Then I would recommend them come and talk to us, of course. Come and talk to EIF also. What was the second question?
Additional benefits that you see in the implementation of ESAs for education providers.
Yeah, it's kind of going back to what I said before. It's really that alignment of interest is very special, and I think it's important because it's basically showing and proving that the education institutions are partnering with the private sector and making sure those students actually get jobs, right? Because they have to get repaid on those future cash flows. And then Of course, if you ask to some of the schools, depend how well funded they are. I mean, if the guarantee would come with an additional, financial support, like let's say 20%, 25%, some like working capital that would allow them to bridge the gap, especially with ISAs where you have totally unexpected future cash flows, that would be also very helpful.
How about you?
Yeah, I mean, the one benefit that I see is obviously it brings in more students. It gives more students the potential to actually enroll. Because without funding, at least what we see, again, with the very international student body, obviously as well, there would be a lot of students that just couldn't afford it, like they wouldn't enroll. We've had that actually, which is interesting, when we switched over to the income share model that year, we also introduced, as I said earlier, that we would offer it to all admitted students, and then they could decide if they wanted to make use of it. That was actually very strong intake that year, so obviously there are always different factors for a strong intake, but that must have been one as well. So I mean, I can just see that, so it has a huge impact, and that idea also that you are actually later, when you're repaying, actually funding the next generation, is that beautiful idea that actually I thought, because I heard it here again, and it was like, we have to use it more actually to make sure our alumni remember that, because that makes a huge difference, I think, first of all, how you feel about it, also because it is also kind of, it's your university, it's your degree, but it's also emotional, it's also people and what you remember. It's also what we're trying to be as a place, like that campus in Bremen, a place to remember. And that if you have that kind of bond, then it is also less likely, again, with the very international student body, that the bond remains, and that so that students don't just disappear, because you could still do that, obviously. So that's a risk, also, that we just never hear from them again. But yeah, so just try, and again, like with additional help, especially for the first years, I think that would make it a lot easier, to start off. Yeah.
Thank you. Then let's open it up for the audience. We are happy to have your questions.
Hi, just a question. I mean, for income sharing agreements, do you then depart from the traditional model where it's like, hey, here's, you're delivering the course, let's say it takes 3 years, at the end of 3 years you're done, I've delivered my content and you're on your own? Do you like follow up with the students afterwards because you now have this financial bond to some degree, and you're like invested in their success going forward? Is there additional things that happen after the kind of traditional delivery of education? That's my question.
Yeah, I mean, we have a strong alumni network, so we have alumni meetings once a year on campus, and we have a dedicated alumni office. I'm not in that office, so I don't know all the details that they do, but we try, of course, to maintain a relationship with our students. I mean, the actual repayment, as I mentioned earlier, is not administered by us as a university, so we have brain capital to do that for us, so that part is not the direct contact with the university.
Maybe another follow-up question. Thank you very much. Very interesting. One question would be on the admission. If I understood correctly, you said that every prospective student gets exactly the same offer, but arguably there could be some differences in employability which you already can foresee during the admission phase. Somebody having very strong internships or having some work experience before. Why did you not, or did you take this into account when making the rates and the pricing?
Yeah, I mean, I didn't say we give the same offer to everybody. I just said we make an offer to everybody. That for a start. But actually, those kind of merit-based kind of considerations, that's our scholarships. So we look at, whatever merit-based award we give, that is based on the academic background, the actual admissions application. The tuition deferral comes in addition, so our income share agreements, they come in addition, and they're not the same. For everybody, I cannot disclose all the details how we're awarding right now, but they're not the same. But we make an offer to everybody. Yeah.
Thank you.
And what we've seen with other education institutions is that they actually, in the admissions process, they really measure and make sure at the end of the day that the candidates that go through the ISA will be successful, right? And they don't just offer that to anyone. Sometimes they call it like some potential fund or some like talent fund or something like that.
Hi, thank you so much. So this is mostly for Lino, but knowing that your company is mostly a servicing company, then how do you manage to align the interests? Meaning that you can potentially, because you also do admissions, in a sense, say, I'm going to onboard everyone because as I'm winning money through the servicing fee, then it will be similarly to us, like saying I'm going to make a big fund as an asset manager, because I get a lot of management fees, and then I will not be attending the most important needs of my investors, which are impact and returns.
Yeah, that's a great question, and the way we solve that is we take servicing fees at a percentual basis. So we are actually partnering with the school on that, and actually it just doesn't work for us if it doesn't work for the school or for us. Basically, the way we've structured the fees, there's too high default rates. We're just like losing money. I mean, at the end of the day, in our kind of business, it has to be volume, and you need to have high repayment rates for this to work.
Please.
Thanks. Another element of alignment which hasn't come up, but which I find quite interesting with the income share agreements, is that I think it's quite common to offer some coaching to the students or to the graduates as they are graduating, because then in order for them to apply for jobs, and also on, for example, the salaries that they would be entitled to, which is not something that every graduate, when they graduate from university, would be necessarily informed on. So I think that's also something that's quite helpful. Don't know if it's general.
I mean, we have a career services office, so I mean, we try to give that kind of support to all our students, but of course it makes a lot of sense, especially to the ones where the salaries depend on the repayment that we're receiving in the end. So this is important, you're right.
Yeah, so in our case, we don't do that service. It's the school's duty, because at the end of the day, they want to make that. Yeah.
Go ahead.
Okay, I would like to ask, what about if a student drops off or he does not manage to be successful in his studies? What happens with the financing? Is there an impact?
Well, the main impact is, I guess, the student doesn't have a degree, so the likelihood that they're earning, is a lot less. So in the current model that is with the guarantee, the student remains in the model. So, I mean, there is a repayment time. If there is, as we heard earlier, if the minimum income is not reached, the student doesn't have to make a payment. So in the end, this is a risk, obviously. So for our university, we don't have a very high dropout rate. So that is good, or that maybe shows also not just the service, but like what do we offer to help students, and maybe how good the programs are. But yeah, of course, this is a risk. Yeah. Mm-hmm.
Yeah? Okay. Are the two of you going to join the cocktails after the signature event, so that further questions can be directed at you?
Yeah, sure.
Thank you.
See you there.
Thank you.
Thank you.